Tyler, thanks very much. The FDIC chair, in testimony he'll deliver tomorrow to Senate Banking, while he says the financial system is sound, he says it continues to face significant downside risks, and those risks come from inflation. Importantly, he says they come from rising interest rates as well as geopolitical uncertainties. He says credit quality and profitability could weaken at banks due to these risks. As well, banks could tighten their loan underwriting standards and slow loan growth. Makes a point of saying more interest rate hikes could heighten unrealized losses at the bank. So here's the FDIC chair kind of talking through the Senate Banking to the Federal Reserve. Some banks have been reporting moderate decline in deposits, he says, but the vast majority say there's been no material outflows. He also says the banks are prepared to access discount window and bank term funding program lending as needed to meet their liquidity needs. Banks, he said, responded to zero interest rates by, quote, reaching for yield. What's important about this section is he's kind of, again, pointing to the Fed's monetary policy as part of the problem at the banks. Michael Barr, the vice chair at the Fed for Bank Supervision, didn't do that in his testimony. He says regulators should review capital liquidity and interest rate risk supervision at banks with assets of $100 billion or more. Regulators, he said, should review the method for resolving banks of that size. So, Tyler, as I reported earlier today, there's some question about whether or not the Fed is thinking enough about the impact of the banks of its monetary policy and whether supervision is kind of like a poor relation to monetary policy at the Fed. The FDIC chair raising some questions about the impact of Fed monetary policy on the banks and why we are where we are right now.
And very interestingly, that phrase in there that the banks were reaching for yield.
Right.
Usually when you do that, it doesn't end well.
No, and it hasn't. And sometimes, Tyler, I remember from the 2008 crisis, sometimes people lost everything when they were reaching for an extra quarter or half point. The FDIC chair points out that the period of zero interest rates that followed the pandemic caused banks to take certain actions, and then those actions had to be reversed when the Fed started hiking aggressively. And remember, Tyler, only one Fed official dissented during that aggressive rate hike period, which was Esther George from the Kansas City Fed, who's no longer at the Fed. And among the reasons she dissented was her concern about the banking industry.